approached earlier this week, in fact last Friday, by somebody who's got quite a few assets in a company. It's an investment company, and they wanted to mitigate their inheritance tax. The problem is the chap who owns the company, Good evening, Shaz, Nawaz here again, and it's that time of the week. It's Finance Friday. What are the disadvantages of a limited company? I think these aren't always fully considered. Chris says hi Chris, and hi Wendy. And there are a number of disadvantages, and I think it's important you're aware of this because all too often I find people are fixated on one particular structure. And if you've heard me speak before, you'll have heard me say one size does not fit all. So in my property business, I have some properties in my own name, some in a partnership, some in an LLP, and quite a few in different limited companies with a holding company structure. So it always depends on the deal and the exit plan and who else is involved and what we're looking to do. Anyhow, back to limited company disadvantages. So the first disadvantage, or the additional cost, is that mortgages or the interest rates can be higher in a limited company than they are in your own name or a partnership. So that's something you need to be aware of. The rates are becoming more competitive, but still are higher than you would expect in your own name. The second issue, which most people usually pick up on, hi Julie, hi Shebs, is that there is double taxation if you have run a limited company. So if the company makes profit, it obviously pays corporation tax. If you then take money out, you'll have to pay income tax. Now that obviously depends on your personal situation. And if you don't have any other income coming in and you take a salary below your personal allowance, there's no income tax to pay. But once you go above that, then you'll have to pay income tax. And depending on how you take the money out, is it salary, is it dividend, is it a bonus? There'll be tax payable and possibly national insurance if you take a bonus or salary, and then the company has to pay employers national insurance. Hi David, hi Helena. So that's the second thing you need to be aware of. And of course, dividends can be tricky because if you can only take dividends out if the company makes a profit or there are enough distributable reserves. So if both of those don't exist and you take money out the company, you'll have taken an illegal dividend. Now, what does that mean? Because I think people make a far bigger issue of this than it really is. Hi Keith, nice to hear from you again. If you take a dividend, and we've got Joshua here, so another property tax expert, and I'm sure he'll share his views as well by posting a message. If you take an illegal dividend, what that means is the shareholders can take you to court and sue you. Now, of course, you'll know from experience, if you have a limited company, that the directors, or the director or directors and the shareholders usually tend to be the same people. So you're obviously not going to take yourself to court. But generally speaking, I know advisors and accountants say do not take an illegal dividend. But if you do, it's not the end of the world. I know some accountants who may listen to this may disagree, but from a legal standpoint point of view, nothing's going to happen because nobody's going to take you to court for doing so. Hi Gary and hi William. So that's something to pay attention to. However, it can get tricky. Most accountants don't like it, so you need to be aware that you need to make profit or have enough in distributable reserves to take a dividend. The third thing, which most people don't tend to like, is that if you have a limited company, it's going to cost you more in terms of compliance and accounts, and then you've got all the additional reporting through Companies House. So you need to be aware that running a limited company will cost you more in compliance costs compared to having the properties in your name. And then you've got the additional or added challenge of company law, articles of association, keeping minutes of meetings, keeping dividend vouchers. I know all you good people listening right now who run a limited company will be thinking, yeah, of course we keep minutes of meetings, of course we keep dividend vouchers, and all of our company secretarial work is up to date, and I'm sure that's the case. Another issue to think about is directors' loan accounts and overdrawn loan accounts. So last week I talked about loaning money to your company and charging interest and the benefit of that. The flip side is if you owe the company money, you either pay interest to the company or it becomes a benefit in kind and you have to file a P11D. In short, it's just more compliance and more work to do. And if you don't file a P11D, which sometimes people forget, then there's fines and penalties. And then if you haven't repaid the loan within 9 months of the year end, then you've got Section 455 tax to pay. That's 32.5%. HMRC hold on to that. And then if you repay it in the next year or subsequent years, then you can reclaim it back. People have a lot of trouble with directors' loans. So you need to make sure if you are running a limited company, you keep on top of that. But again, that's another issue, pitfall, disadvantage to think about. Benefit in kind. So if you, as I've said earlier about the interest on the loan, or if you have a company car, or if you have anything else through which you personally benefit, then you have to pay company car tax. And I did run you through, you have to pay benefiting in kind tax. And I did run you through some of the tax-free benefits last week. But generally speaking, you'll have to pay tax, and that can be extortionate, especially if we have a car and it's not an electric car. Electric cars, very good, no tax this year, next tax year 1%, the year after 2%. So the government is encouraging people to have electric cars. Any other cars, benefiting kind tax, it's expensive. Something else which you need to bear in mind is if you have a limited company, you've got more exposure because your information is on company's house. So if privacy is an important thing to you, do not have a limited company. You're better off having a sole trader or a partnership. But if you have an LLP or a limited company, there's more exposure. This next one is a real big one, especially if you have a serviced accommodation business. So if you're running a limited company and let's say you've got capital allowances through your serviced accommodation business, you write off those capital allowances against profits. So you may end up paying no tax in a particular year, but you obviously got the money sat in your company bank account. If you take that money out personally, you'll have to pay income tax. Now let's switch that scenario to a sole trader where you are the business. You've made £100,000 in profit. You've got £100,000 worth of capital allowances. You can write off that year. You write that off against profits. You've still got the 100 grand sat in the bank account. I'm keeping it simple, but you've got the 100 grand sat in the bank account. You can take that money out, buy a car for yourself, go on a holiday, pay off your mortgage, do with it as you please. So you've got that access to cash. So it could be that having a business in your name and claiming capital allowances allows you to get tax-free money and a big chunk of it. Another issue to consider is if you have a partnership and there's two of you and you own the shares 50-50, let's say you've gone into partnership with a school friend or a university friend or your next door neighbor. If you own the shares 50-50, you don't have to split the profit 50-50. So one partner can say to the other one, you can have 75% of the profit this year, I'll have 25%, and that's absolutely fine as long as the partners agree. In a limited company, it doesn't quite work like that. If you only have ordinary share capital and you own half and your friend or your business partner owns the other half, if you take a £10,000 dividend, they have to take a £10,000 dividend. You can use dividend vouchers, but that gets complicated. HMRC don't like it. Something else which is a disadvantage is if you have property in a limited company, you don't get an annual exemption. If it's in your own name, you've obviously got an additional £12,000 per year to use up. If you live in the property in a limited company, you get no principal private residence relief, whereas if it's in your own name, you get that. That can be very beneficial. Hi Suresh and Mr. Mecca. And if you own a company, property in a company and you live in it, then you've got all the complications of annual tax on envelope dwellings. You can see how this is all building up. So that's another issue. But generally speaking, you need to go through all of this in detail, see which option works best for you. If you're solely looking to grow your business, then most likely Section 24, having a limited company will be better for you, especially in light of Section 24 issues. And of course, you can just pay corporation tax, keep the rest of the money there and recycle it, especially if you're a high rate taxpayer. Hi Samantha, nice of you to join us. So that could make it worthwhile or useful for you to have a limited company. If you are thinking about inheritance tax, then usually if you approach a good accountant or tax advisor well in advance, then if structured properly, there are some good inheritance tax planning options available to you through a limited company, which aren't available in your own name. So good stuff there. I was approached earlier this week, in fact last Friday, by somebody who's got quite a few assets in a company. It's an investment company, and they wanted to mitigate their inheritance tax. The problem is, the chap who owns the company, he's 91 and his wife is 89. That leaves minimal, if any, decent inheritance tax planning available. Had they come to me, say, 10, 15 years ago, we would have been able to do quite a bit for them. But unfortunately, at their age, the hands are pretty tied. So inheritance tax should be looked at earlier. So some of the key things I think you should be considering before deciding which structure to use. A, look at the flexibility, which one gives you the most flexibility. Secondly, admin costs and compliance costs. Third, tax costs. Fourth, other commercial considerations in terms of being able to loan money and bringing other parties in. Fifth is privacy. If privacy is important to you, then maybe having a business in your own name is a better idea. Then if you're looking to also to introduce people into your business, then you need to be thinking about share options and versus giving away capital in your sole trader or partnership business. So think about that carefully. And then you've got employment related security issues, which you also need to think about. And then finally, be very clear on your exit strategy and see which particular structure gives you the best outcome. Like I've said, use all of the structures where you can, when you can, because they all have different advantages. CH Mecca says, can you put a limited company into a trust when you die? You can do, but generally speaking, what happens is people form that trust before they die, and then the trust owns the property or owns the shares in a company, and then they have beneficiaries. So that's how that works. I hope you found that useful. Thank you very much for joining me. I hope you have a fantastic weekend, and I'll see you next Friday for Finance Friday. Bye for now.